The top stories live from the Sky News City studio. Deliveroo shares plunge on their first day of trading on the London Stock Exchange as concerns over drivers' pay cast a shadow over the biggest listing in the city in a decade. More than £6 billion in COVID insurance claims and a near £1 billion loss. Lloyd's of London counts the cost of the pandemic. Two major UK theatre groups come together to face a post-COVID future. Just how quickly can the sector bounce back? And 135 years to close the gap, why the pandemic means it will take another generation to reach parity between men and women. Good morning, this is Ian King Live, an hour of business and economic news from the heart of the city. It's a big day for Deliveroo and a symbolic moment for the wider gig economy in the UK as the food delivery services shares started trading on the London Stock Exchange this morning, and it has not gone well. The shares plunged on opening in the last couple of hours. They opened more than 25% lower and they're currently some 20% off. There's been no shortage of controversy around the initial public offering. Many big investors have decided not to take part because of concerns over how Deliveroo pays its drivers. Well, shares were priced at the bottom of the expected range, valuing the company at some £7.6 billion. It's now worth more than £2 billion less than that following the crash in the share price. Well, for the very latest now, I'm joined by Neil Wilson. He's Chief Market Analyst at Markets.com. Neil, welcome to you. So what's the price doing right now?
Yeah, it's trading around this sort of £3 marker, and I think it's after the first hour of trade, we can pretty much say that that's probably where it's going to be kind of settled for the rest of the day. We'll see what happens, obviously, into the close of the session. Worth bearing in mind that this is still conditional trading, so unconditional trading doesn't start until April the 7th, but it's not a very promising start for Deliveroo this morning.
It really isn't. I mean, this just isn't supposed to happen at IPOs, is it? I mean, most companies coming to market leave a bid on the table, so you get a first day pop in the share price. Why do you think that hasn't happened here?
Well, I think that there's probably all sorts of reasons that are at work. It's not unusual. Well, it's not entirely unusual that shares can fall on an IPO. We saw that with Facebook. Remember, it didn't get off to the best start in the market. So these things can happen. But I think the IPO pricing is clearly outlined with what the wider market is wanting to pay for it. So the bankers that have been working on this maybe need to ask a couple of questions. They priced at the bottom of the range, but even that proved too much to swallow for the wider market. I think the fact that these big funds like Aviva and Aberdeen, for example, have not been on side is clearly a big problem. And that plays into the sort of problems about workers' rights and the dual class share structures. So there's all sorts of things that are at work here. But fundamentally, it's that the pricing was wrong, and the market is not necessarily that keen to pay up as much for growth as it may be used to, as we've seen interest rates rise.
Neil, one thing I can't get my head around is that only 48 hours ago we were told that the offer was more than fully covered. In other words, there were applications for more shares from would-be investors than were actually being sold by the company. I can't understand, when the book was more than fully covered, why this would happen.
Yeah, I think it's just it's indicative of the fact that you set the price, but investors that have got in are selling at that level immediately and don't want to participate in the longer term growth story, if there is one, for Deliveroo. I think we also need to see. It'd be interesting to find out. I'm certainly interested to look at what sort of potential short selling has been taking place. If there's already been shares being offered out on loan for short sellers, that'd be an interesting one to look at over the next few days.
All right, Neil, good to talk to you as ever. Thanks very much for joining me today. So how much damage has been done to the brand, and what now for the company and the sector? Well, joining me now is the Chief Growth Officer at digital agency Somo. That's Rebecca Crook. And I'm also joined by the co-founder and managing partner of the tech investment firm GP Bullhound, Manish Madhvani. Welcome to you both. Manish, let me start with you. Just how much of a setback is this for London's ambitions to attract more tech companies to the market?
I think it's obviously drawn a lot of headlines this morning, and I think London was starting to get some momentum with a number of the companies choosing to float in London versus the US. I think we've still got to realise that it's still highly valued, the company. I think Neil raised some good points there, that the pricing was set above many of its peers, and some of those are growing much faster than Deliveroo are at the moment, companies like Glovo and Just Eat. So I think we've got to see there's still a huge amount has been raised, but I think there has been a bit of a mistake on the pricing, just in light of some of the market conditions.
Manish, worth pointing out, this is hugely embarrassing for Rishi Sunak, the Chancellor, of course, who put his name to the IPO and called this a true tech success story.
I think that is right. I think we should not forget how pioneering the Deliveroo model is, though, because I think you often get caught in these headlines and the price, how much they're going up and down in a certain period. I mean, we won't know the true impact of the Deliveroo IPO for many years. When you do look at the numbers on the Deliveroo business model, it's serving a staggering number of customers, 6 million plus. It's growing 60% plus on many of its metrics, and it's really brought huge convenience to consumers. I mean, you can order anything now, from anything from groceries through to takeaways through to high-end restaurants. And I think that convenience is that comes at a cost, and we've got to keep supporting these amazing tech companies to deliver that. So I think we've got to take the longer term view on whether this is successful or not.
All right, Rebecca, let me bring you in. There's a lot of commentary around the profitability or otherwise of this company. It looks as though some investors still do have major concerns on that front.
Absolutely. I think that, as being covered, they have really disrupted the market. They have innovated. They are in a great space. But, I think there's three challenges that they've got, which I think has probably made the impact around the price. I think firstly is, they've had a great year. They've been one of the people that have benefited from COVID, with people ordering during lockdown. Is that going to continue as restrictions ease? Probably not. So there's some hesitancy there around kind of what their profitability might be in their market share over the next 12 months and so on. They really need to look in terms of how they're going to diversify the company. I think secondly, the kind of the dual share, I think some investors may be put off by that, not having full control. Obviously, it's great for the founder because he can focus on the long-term growth of the company without kind of risking what may happen with shareholders. But I think the most crucial thing absolutely has to be this whole thing around gig economy. Obviously, we've seen Uber massively impacted by that, and that's going to come to Deliveroo, and that's a massive concern for investors and something that Deliveroo need to be concerned about.
Rebecca, let me just go back to what you were saying there about the dual shareholder structure at the moment, which effectively gives the founder control of the company. I mean, this is something that is pretty alien to the UK stock market.
It is slightly unusual, although quite a lot of, I guess, kind of fast growing tech startups do take this approach. And it's really so they can focus, I guess, as the founder, the CEO can focus on that long-term growth for the company. They can focus on the performance, the strategy, where they're going next, without really worrying about, are they going to be disrupted at share meetings by shareholders. So really for them, it gives him the ability to focus on, I guess, where he wants to take the company next. And to my point about diversifying, that's going to be a key pillar that they're going to have to focus on over the next 12 to 18 months, because there's other entrants in the marketplace that are doing well, and people are moving into their own spaces as well, and obviously investing a lot in their own logistics. So there's going to be other people coming to play too.
Rebecca, do you think that this business, you said it was a winner during the pandemic, but it didn't make a profit during the pandemic? And I mean, some people might say, well, hang on, before Amazon took a stake in it, it was nearly going bust.
No, absolutely. But I mean, I think kind of the general trend is for all of these tech startups, if you look at any of them here in the UK or the US or right across the globe, it takes a long time for them to turn over a profit. Their strategy is always about grabbing that market share as quickly as they can, speed to market. So it's not unusual now for kind of investors to kind of play the long game and hope and predict that they'll start turning over that profit.
Manish, big question now. Is this going to impact the sentiment towards other tech IPOs in London?
I think it always does a little bit. It will dent confidence. And I think it's really important we do create this ecosystem in London for our great companies to float, because I think so much good work has gone into creating unicorns and billion-dollar tech companies that are now becoming really global household names. But we're doing all of this hard work, and the entrepreneurs are growing these amazing businesses. And then when they reach this level, too many of them are still having to float in the US. And that is a problem with our analyst coverage and our confidence. You think about the dual class shares, you think about the loss making. I mean, it's proven time and time again when you look at the US companies who are backing the Amazons, the Zooms, the Shopifys of this world. They back them, and make sure the unit economics work at a fundamental level, but then allow them to keep growing at a massive rate. And that's how you create these true champions. If we don't do that in London, we will keep losing these great companies to the US, and so much capital, so much intellectual capital and finances drip out of the ecosystem. So it's really important we start getting our heads around that, and we've got to get braver.
All right, Manish, Rebecca, very good to talk to you both this morning. Do appreciate it. Thank you. Now, Lloyd's of London.